Yeah, that's right, Tila. So analysts say there is still scope for the Reserve Bank to cut interest rates today. So it's likely to be only a 25 basis point cut. Most analysts agree that the bank is nearing the end of its rate cutting cycle. So far, the bank has cut interest rates by a whopping 275 basis points in response to the impact of COVID-19. So inflation is at its lowest that it's been in 15 years and may support the case for a rate cut. Since December, the prime lending rate at banks has dropped from 10% to 7.25%. And joining me now to discuss this further is Dr. Adrian Saville, who's the Chief Executive at Cannon Asset Managers. Dr. Saville, many thanks for your time this morning. I think you agree with many of the analysts that are anticipating a cut. Why wouldn't the Reserve Bank then move to hold interest rates given the steps that they've taken, the bold steps that they've taken in previous meetings?
Good to be with you. If you take the move in interest rates and the move in inflation alongside each other over the course of 2020, although, as you point out, interest rates have been cut by 2.75% from the start of the year, the inflation rate has fallen by 2.4%. And so in the note that we released yesterday, our observation was essentially the interest rate cuts have been defanged by the fall in inflation. And if you put those two numbers against each other, in effect, the interest rate has really only been cut in real terms by about 0.3%. So if the ambition is to aggressively stimulate the economy through interest rate cuts, the fall in inflation has reversed a lot of that aggression, leaving scope still for further rate cuts.
Let's focus a little bit more on that inflation. So some of the factors that would affect the inflation expectations that we can look forward to, what would those be?
Well, I think you're absolutely right, in underlining the word or highlighting the word expectations, because although I'm talking about inflation having fallen, that's backward-looking, and that we know. What the Reserve Bank is always trying to do is to manage interest rates against anticipated inflation. And one of the big components that makes up the inflation basket is the fuel price. That is likely to rise from here, given the strong recovery in oil prices. But against that backdrop, you've got an economy where demand has absolutely evaporated. And if you look at activity in the retail sector as an obvious barometer or guide of what we can anticipate the economy to do in the foreseeable future, there's very little evidence to suggest that the demand side of the economy is going to translate into higher inflation. Our expectation is that inflation rates remain very, very subdued. Around the current levels of to perhaps into early 3%, but not much more than that.
Yeah, and I'm glad you bring up things like retail sales, economic data, as you say, really painting a bleak picture. Would you think then that the Reserve Bank might revise the growth outlook for South Africa from the 7% that they previously gave?
To use the language of economics, the Reserve Bank here would argue to be behind the curve, that they're revising their growth forecast down at each MPC announcement, but that revision is sort of catching up with other forecasts made by the likes of the World Bank, the IMF, the OECD, and independent or private sector bank economists. So, the Reserve Bank's forecast of the -7 is lighter than some of the numbers that we're seeing where World Bank, OECD are pointing to -8, and some of the bank economists and private sector economists are talking about -10 or even more. I wouldn't be surprised if there is a further revision downward in the Reserve Bank's growth expectation or a shrink expectation.
Yeah. Dr. Saville, I mean, this is probably a very difficult question for you to answer because of the dire situation. But apart from the Reserve Bank boosting the economy as much as it can, what else can be done? Because these are very dire numbers that you give us in terms of the growth forecast being revised downwards, really, really scary figures that you're giving there.
South Africa came into COVID in a very difficult position. I would venture, as an economy, as a country, we came into COVID in crisis. Take any of the headline metrics: unemployment sitting at 30%, youth unemployment at almost 60%. Per capita incomes are the same today that they were 10 years ago. Forecasts for economic growth were glib, and budget deficits running way ahead of our ability to fund them. So the country came into COVID in very bad structural shape. And as recently as late 2019, there were calls for structural reform. Those are still to materialize. So there's ongoing discussions about the structural reform and the need to restructure the economy. There's little evidence of that having come to fruition. So the Reserve Bank rate cuts will help in that they will provide relief, but they are not going to provide reform. And in the absence of reform, South Africa is going to remain economically in a very, very stuck place.
Very interesting insights there. The Reserve Bank going to provide relief and not reform. Those are the words coming from Dr. Adrian Saville, who's the Chief Executive at Cannon Asset Managers.
Right, Rofhiwa, thank you for that.